You've got a tidy flat in Valencia with morning sun and a balcony that practically begs for orange trees. You decide to rent it out. The first month goes great. Money lands, the tenant seems normal, life is good, until a letter arrives with a logo and a deadline. Suddenly every coffee you've sipped on that balcony flashes before your eyes. Start with who you are in Spain's eyes, because everything else hangs on that. If you're a Spanish tax resident, Spain taxes your worldwide income and your rental goes on your annual personal return. If you're not resident, Spain only cares about Spanish source items like rent from a Spanish property, and you use a non-resident form each quarter. That single fork, resident versus non-resident, decides your rates, your deductions, and your calendar. Don't guess. If you spend most of the year in Spain, or your life is truly anchored here, you're probably resident. If you live abroad and just own a place in Malaga you rent to tourists, you're likely non-resident. Get this status right first. It's the key in the door. Now ask what kind of rental you're running. Spain looks at long-term residential leases one way, and tourist short stay lets another. A classic housing lease, someone's primary home with a standard contract, sits in the real estate capital box for most people. A tourist rental, short stays, rotating guests, bookings on platforms, still usually sits in that box. But the more you act like a hotel, the more you drift toward a business with different rules. Daily cleaning, reception, breakfast, and organized hospitality services can push you into the hotel-like lane where VAT appears and municipal scrutiny follows. Know your lane before you list. Residents first, because many of you will be. You'll report the rent in your annual personal income tax. You don't pay on gross, you pay on net, rent received minus allowable expenses. Then the result flows into progressive rates. Allowable is generous when you do it right. Mortgage interest connected to the property counts, community fees, building insurance, property insurance, small repairs, and maintenance count. Advertising, agent commissions, and legal fees linked to the tenancy count. IBI, the annual municipal property tax, counts. Utilities you pay as landlord count. And then there's the quiet heavyweight, depreciation. Spain lets you deduct a yearly amount for the building's wear and tear, normally calculated on the construction value rather than the land. People ignore this and leave money on the table. Don't. It reduces your taxable rental income every year. And yes, it affects your gain when you sell, because the tax system assumes the building got older, whether you claimed it or not. Claim it carefully with the right base, and you won't be explaining your math with a trembling voice later. There's another resident-only concept you'll hear about over coffee. A statutory reduction for net rental income on leases used as a tenant's main home. The spirit is simple. Spain encourages long-term housing, and if your lease and conditions fit, a percentage of your net rental profit can be tax-free. The exact percentage and conditions have shifted with housing reforms and can vary by situation, so you check the current rules the year you file, and you keep evidence that your tenant actually used the property as their main residence. When that reduction applies, it's rocket fuel for your after-tax yield. When it doesn't, you still have your deductions and depreciation to anchor the result. Non-residents, your world is more mechanical. Your rental gets reported quarterly on the non-resident form, one per property and quarter, with payment. If you're tax resident in the EU or EEA, Spain typically lets you deduct the same sorts of expenses proportionally against your gross rent and pay on the net at a flat rate that's friendlier than residents' top brackets. If you're resident outside that zone, Spain historically taxed your gross at a higher flat rate with no deductions, which is why many non-EU owners structure carefully and watch their costs. Whatever your passport, you file the quarter after you collect. The calendar is unforgiving, and you keep the receipts that tie each expense to the rental. Skip the quarterly routine and the late payment interest will do cardio on your wallet. Everyone, no matter your status, has the same supporting cast. IBI arrives each year. You pay it and keep the receipt. There's often a separate rubbish fee. Keep that too. The Homeowners Association wants its monthly quota. Those letters belong in your rental folder. If you use a letting agent, you download their statements and invoices. If you repainted or repaired the boiler, you save the invoice in the bank line that proves you paid. If you renovated and raised value, you keep the contractor contract, city permits where required, the invoice, and proof of payment so you can classify properly later. Repairs keep things working and are usually deductible now. Improvements extend or enhance the asset and may be handled differently. Label each one in the moment while the paint is still drying, because trying to decode invoice 0042 a year later is a special form of regret. Short stay and tourist landlords need a separate lamp. Regions regulate tourist apartments heavily. There are registration numbers to obtain, platform display rules to follow, occupancy limits, and neighbors who know exactly whom to call when your Saturday check-in sounds like a bachelor party. Some cities also layer on tourist taxes per guest per night, invoicing quirks, and enforcement that actually enforces. Do this properly before you host your first guest. If your offer drifts into hotel-like services, frequent cleaning, meals, staffed reception, you can trigger VAT at a reduced rate on the service element and other business obligations, which changes your pricing, your invoices, and your filing. If you're a pure lodging host without services beyond the basics, long-standing rules keep residential lets exempt from VAT. The line is not vibes-based, it's about actual services provided. Pick a side and stay on it. Withholding is a sleeper variable most people discover when it's too late. If your tenant is a company renting for staff, they may be required to withhold a percentage of each payment and pay it to the tax office on your behalf. That's not your tenant being mean. That's the law. You then report the gross rent, subtract expenses, and claim the withholding so you don't pay twice. If your tenant is a family renting your flat as their home, there's normally no withholding and you handle the entire tax yourself. The lease terms and the nature of the tenant, company versus person, housing versus business use, decide who withholds. Ask before you sign and put it in the contract. There's a tiny monster in the basement that matters if your place sits empty part of the year. Imputed income is Spain's way of saying a second home still provides a benefit. Residents report a small calculated amount for the months the property wasn't rented. Non-residents pay a small annual non-resident imputed tax for vacant periods. It's not huge, but it exists, and missing it makes auditors suspicious about everything else. If your flat was vacant for February and March, you note the dates, and the next time you fill out your return, you include the imputation with a sigh and move on. When you sell, the tax story changes chapter. You'll pay capital gains tax on the actual profit. Selling price minus acquisition costs, minus selling costs, minus the value of improvements. With depreciation you claimed, or could have claimed, reducing the building's base and pushing the gain up accordingly. That's how depreciation works. It helped you every year, and then it's reckoned at the end. There's also a municipal levy tied to land value increases over time. Reforms made it more sensible, but it still exists, and the buyer's notary won't let you forget it. If you were a non-resident, there's a standard withholding at sale designed to prepay your capital gains bill. You later file to reconcile the actual tax and get the excess back. Selling is paperwork, not a horror film. If you kept invoices, notary deeds, taxes paid, and proof of improvement costs in one folder. Let's talk cash flow, because taxes are patient and landlords get antsy. The easiest way to avoid tax surprise is to treat taxes like a bill you owe yourself the day the rent lands. If you're a resident, sweep a calm percentage of net rent into a separate taxes account every month. If you're a non-resident, look at your quarter's gross, subtract your expenses if you can, estimate the tax, and park that amount until you file the quarterly form. The problem most landlords face isn't the rate, it's the rhythm. They spend every euro and then scramble at quarter end. Don't be that character. Create a quiet standing order that moves the tax share into a lava sub-account you never touch until filing day. Now, the 4 places landlords accidentally set their money on fire. The first is confusing repairs with improvements. Replacing a broken boiler to keep heat on? That's a repair. Knocking out walls and adding a bedroom? That's an improvement. The treatment and timing differ. Mislabel one as the other and your numbers wobble. The second is forgetting depreciation. It's there. It exists. Calculate it correctly, based on the building value, and claim it yearly. The third is tourist compliance. Regions issue fines to unregistered properties that make rent look fun, but illegal. Get your tourist registration and display the number. The fourth is paperwork laziness when tenants change. New lease, new deposit, new handover inventory, new agent contract if you use one, and new utility arrangements. If you ever need to prove a period was rented, those papers are your shield. Speaking of deposits, Spain treats them seriously. For housing leases, there's a legal deposit that must be lodged with the regional authority in the format and timing the region requires. Many regions let you do it online. Some allow additional guarantees in the contract. Mishandle deposits, and you can't enforce parts of your contract later. Do it properly once, and you'll never think about it again. Insurance is not just a checkbox. A standard policy on an empty home is not the same as a landlord policy that covers tenant damage, loss of rent in certain circumstances, and civil liability. The premium is a deductible expense. The peace of mind is priceless the first time a washing machine decides to launch a water feature into the downstairs neighbor's ceiling. Your future self will send you a thank you emoji. There's also the quiet question of scale. If you own 1 or 2 flats and manage them yourself, you're squarely in real estate capital territory as a resident. If you build a mini empire and hire a full-time employee to manage rentals, Spain can treat the activity as an economic business. That shift brings business-style obligations and potential benefits, as well as different social security considerations. You don't stumble into this, you plan it if you plan to grow. For most landlords, staying in the simpler lane is both easier and more profitable after fees. Let's stitch all of this into a one-evening setup you can actually do. You start a folder for the property with subfolders for lease, tenant documents, agent contracts, deposits, taxes, invoices, and utilities. You make a single spreadsheet page with 12 lines for rent in, a column for each expense category, and a line that calculates monthly net and a suggested tax sweep. The moment rent lands, you move the tax sweep into the lava account. When you pay IBI, you drop the receipt into the taxes folder and type the amount into the spreadsheet. When you fix something, you snap the invoice, label it repair or improvement that same day, and file it. At quarter end, if you're non-resident, you have everything to fill the form in 15 calm minutes. At year end, if you're resident, you have the whole year's story on one page and a receipts folder that looks like an adult owns it. If you're listening to this while scrolling a rental platform and wondering which structure makes taxes easiest, the boring answer is also the best one. Use the standard housing lease if your tenant will live there. Use the tourist regime if you truly run short stays. Register properly. Pick one, and then run it cleanly. Don't mix half and half. Don't do a long-term lease and also run weekend sublets on the side. Don't bargain away withholding in a corporate lease like it's optional. Spanish tax loves consistency. So does your sleep. You buy a Barcelona flat for 300,000 euros. The cadaster shows a split where land is a chunk and building is the rest, and you document it. You rent it long-term for 1,300 a month. Each month you pay 90 to the community, 25 for insurance, and you set aside an average of 60 for routine maintenance. Once a year, you pay 450 for IBI, and twice a decade, you expect a 2,000 euro sting for a boiler or a big paint job. You calculate your annual depreciation on the building value, not the land, and you put that number in the spreadsheet on January 1st so you don't forget it in December. You file your resident return in spring with net rent, and if your lease qualifies as a primary residence and the year's rules offer a reduction, you apply it with the lease and tenant certificate sitting in your folder in case anyone asks later. If your tenant leaves in August and it's empty for 2 months, you note the dates and include the tiny imputation for those months. Nothing about this is dramatic because you set up the structure before you took the first euro. If you're non-resident in, say, Germany and you own that same flat, you collect the 1,300. You total your quarter's expenses that directly belong to the rental. You calculate your quarter's net and the flat rate that applies, and you file and pay before the deadline. If you decide to Airbnb it instead, you register as a tourist property with Catalonia. You obey the platform rules about registration numbers. You collect any tourist taxes the city requires, and you keep your invoices the same way as the long-term landlord. If you add daily cleaning and breakfast, you speak to a tax pro about whether VAT applies, so you don't wake up one morning as a secret hotel. You bought the place for sunlight and cash flow, not paper cuts. Spain's tax system for landlords won't bite if you feed it the right documents on schedule. Do that, and your balcony remains a balcony. Your coffee remains a coffee, and your rental becomes what it should have been all along. Patient, boring income in a country where the oranges taste like holidays.